and welcome to tonight's Property Fireside discussion. My name is Cameron Talbot, and I'm the Investor Relations Manager at VentureCrowd. Thank you for taking the time to join us tonight for the Venture Talk and Update. For those that don't know, VentureCrowd is a digital investment platform that specializes in alternative asset investments, specifically venture capital and property development, investment opportunities available to retail as well as wholesale investors. The purpose of tonight's webinar is to provide you with a front row virtual seat for a candid conversation about the state of the Aussie, particularly Queensland property market. In tonight's webinar, you will find out how property crowdfunding can be viable, an alternative way to enter the property market, as well as you will learn more about VentureCrowd's current property projects and our approach to property development. We'll also make time at the end of the update and the chat to address any questions that you may have for either David or Steve co-hosting tonight's discussion. Please do make use of the Q&A button at the bottom of your screen. Type any of your questions or comments there, and we will allow for time at the end to address that in a live environment for you. Kindly note that this update is being recorded and will be circulated in the next couple of business days to all investors. If you want to find out more information about any of the properties that will be in discussion tonight, please do go to the VentureCrowd website and view the options there to invest. If you have any questions, you can ask for a call or send an email through to us, and we'll be happy to assist you as best as we can through the investment process. Now, I'd like to introduce our panelists for this evening. I am joined by VentureCrowd's founder and CEO, Steve Maarbani, and the head of property, David Whitting. I'd now like to take this opportunity to welcome Steve Maarbani. Steve is the CEO of VentureCrowd and is a corporate lawyer and former PwC partner specializing in funds management, and is responsible for the legal, compliance, and asset management principles of the fund. Good evening, Steve.
Take myself off mute. Hey, Tam, and good evening, everybody. Well, this is going to be the hottest topic in the market right now. There are so many different points of view, so many sensationalist headlines. It's really difficult to filter the reality from the noise. And that's what we're going to try to do with you today. We all know that there's uncertainty in the market, but that's always going to be the case. So how do the best in the business think about navigating the property market during times like this? And what processes do they use to make informed decisions about those pockets of the property market that have the potential for material growth, even when there's lots of noise in the market? So today, as Tam mentioned, I'm joined by one of the most experienced property executives in the country. David Whitting has over 25 years experience in property development. He's currently a partner at Whiting Partners, as well as being the head of property at VentureCrowd. David was previously the Queensland General Manager of Grocon, Project Director for Lang O'Rourke, and State Director for Multiplex. He specialises in strategy, acquisitions, disposals, structuring, project initiation and approvals of institutional grade asset development over commercial, residential and retail sectors of the market. So enough out of me, let's get on with it. Mr. Whitting, thank you for being here to share your insights with us. How are you?
Thanks, Steve, and thanks for inviting me here tonight. I'm well, thank you, but it would be nice to see some clear numbers and stability in the market, wouldn't it?
Yeah, it would. I mean, there has been a lot of uncertainty about the state of the property market over the last 12 months. I am reminded, though, that when COVID hit, economists were predicting 20% falls in property prices. Not only were they wrong about that, the period of growth that followed was pretty spectacular. Now we've got a new suite of dramatic headlines focused on how interest rates and inflation are going to, be the end of mankind, all of which can be very, very confusing for investors. Help us make sense of what's really going on here. What do you think the numbers are telling us? And what do you think this year holds for the Australian property market?
Yeah, sure. Thanks, Steve. Well, as you see by my slightly steely white hair, I have been through a few market cycles. So one thing I can say to our audience is these things are always cyclical. So it's a question of where we are in the cycle and what your investment parameters and horizons are when you're thinking of investing. And as always, things are a little bit more nuanced when you're looking at both particular geographies, particular market types, etc. So we should delve a little bit more into those as we go along. But in terms of the macros, obviously inflation numbers are retrospective, but they're likely to be near the peak. Canada's is falling, so as the first of the Western nations, and the Fed is not too far behind as well. The Canadian hiked to 4.5%, so they hiked, 4.25. We've risen a bit more slowly than others, although by the news you would not nearly necessarily think that's the case. And of course, we're at 3.35 currently. Latest predictions from CBA and the ANZ are that we'll probably get up to at least 3.85, and some are saying, a peak of around 4. But one, heartening thing is that the RBA's view is that wages growth will kind of match that as well. Their predictions were for kind of 4.2%, although the wages growth annualized to date is actually below that at 3.3, which is actually a good thing. So that will stop the problem that the RBA was worried about, which is wages growth matching the interest rate rises, and they would have to kind of keep going. So I think most predictions are for the interest rate cycles to finish in the second quarter of this year, and to probably normalise. They may not go down, but certainly kind of flatline for the second half of this year. So I suspect that Philip Lowe and the RBA is hoping that other countries will kind of do the heavy lifting because they're ahead of us in that interest rate cycle, and hopefully some of those larger economies will help kind of smooth that inflation cycle, because of course a lot of that inflation is caused by things which are outside of our control, whether it's fuel, and heating prices in Europe and other things, disruption to supply lines occasioned by the Russian-Ukrainian conflict, and things that are totally outside of Australia's control. So some of those larger economies hiking faster than us might actually do us a bit of good. So in terms of what that might mean for the market and home buyers, well, we think there are some upsides. Unemployment is, of course, is at 3.7, is at a 50-year low. Net interstate migration is back with a vengeance. Federal Minister Claire O'Neil is talking major changes to the broken migration system. And that might be including supplanting temporary migration categories with much more permanent ones, which, of course, for a housing market is a really good thing. Over the pandemic, the average Australian house price rose some 20%, rather than going the other way, which as you were saying, some forecasters were talking about. But it's only fallen on average by about 7.2, and that's of course across the market. And there are some nuanced markets there. So, Sydney's the worst at about 13.8% to February 2023. So, in essence, what that means is that pre-pandemic purchasers have about an extra 13% value still left in their homes from that kind of date in March 20. So analyst Jarden predicts a 10% gain in prices in 2024 if various measures are affected, including the easing of the 3% serviceability buffer to 2%, which banks are talking about, and the implementation of the stage 3 tax cuts, which of course are legislated and baked in. And I read this morning that banks are responding as well. So some of the majors, so the subsidiaries of the majors like NAB's UBank are doing 35-year loans for refinancing or new buyers. And there are some non-bank lenders such as Pepper and RACQ Bank which do 40. And of course, what that means is that investors or owner-occupiers are able to get in for, albeit longer terms, but with lower monthly interest rate payments. Now, of course, you can cut that loan term back later when you refinance and things like that, but the market always finds a way to help investors and purchasers kind of get into that market, and we're kind of seeing that. So we think there'll always be opportunities in the property market, no matter what stage of the cycle. And if you can kind of afford to get in now, you should be doing so, because as prices start to rise, potentially later in the year or 24, of course, what we're seeing around now, we think is around the bottom of the market.
Yeah, that makes a lot of sense, doesn't it? I mean, there's always a reason for drama, and the next one will be, the prices are increasing at a rapid rate, and everybody's coming back into the market. And what are we going to do about price escalation? So, look, until we get to that, which no doubt is coming, where we are today is, the numbers you've just described tell a story of, I think, an economy which is coming to the end of the uncertainty. Exactly when that's going to happen and how that'll happen will be a matter of time. It's anyone's guess. No one has a crystal ball, not even us. But
Or the RBA.
Or the RBA, or any of the economists, it appears. So, but the fact is, those discussions, those observations you made about other Western economies is beginning to tell us perhaps where we're heading here. And certainly that's what I'm reading as well. If that's right, then it means the doom and gloom, I think, of the front pages perhaps is overstated, and that the opportunity right now is in relation to property projects that are strong on the fundamentals. So if that's right, can you share with us the kinds of things that you look for to identify suburbs that have the strongest possible growth potential, even when there is this kind of noise in the market?
Yeah, look, absolutely. I mean, generally we pick about 6 fundamental drivers of the market that we look at when we decide to invest in a particular suburb. We do commission independent reports as well to substantiate those. So that's not kind of, put our thumb up to the wind and see which way it's blowing. We've got a really good bank of professionals that work with us to really kind of break open the kinds of categories that I'll talk about. So, of course, one of those, and we've kind of talked about them, is economics and employment. So what are the employment dynamics of an area? How many jobs are being created? What's the profile of the jobs, and therefore the potential purchasers? Are there employment options in the area? What industries are they? So obviously income helps drive property investment and the ability to meet rental and mortgage payments. So it's a really, really important factor. We look at general population growth and demographics. How many people are coming and going from a particular area? What types of people are they? Are they families, young couples, boomers, uni students? And we segment those markets. Obviously, certain demographics will be more inclined to invest in property or be, solid long-term tenants. And some geographies are suited to those, commuter suburbs to CBDs or suburbs that are in that kind of southeast Queensland, travel zone. We look where there has been or is to be significant infrastructure investment and government spending. New roads, hospitals, transport, schools, universities, retail, sometimes airports. So some of those, it's not always government, sometimes it's the private sector. So, with our Glenvale project being probably the dormitory suburb for, that new private airport in Toowoomba. So we look at generally supply and demand statistics, how many new, dwellings are being constructed, what's the underlying demand, is the location undersupplied or oversupplied? One measure is, of course, vacancy rates, which are really topical at the moment. And, pretty well any suburb in southeast Queensland where historic, good historic vacancy rates might have been around 3%. There are many, many suburbs now that are well under 1%. And that actually talks to a complete structural undersupply of investment dwellings. And of course, people should remember that there's a lot of talk of build to rent and government housing and what have you, but the private, i.e. family investment market, supplies almost 90% of houses for rentals in Australia. Government, of course, picks on them a fair bit in terms of changing rules and making compliance really difficult and changing taxation rules. But as everyone knows, it's one of the great kind of intergenerational wealth builders in terms of being able to have, the Australian average of 1 to 2 investment properties in a family. So there's, it's pretty rare, despite governments banging on that somebody has 20. You hear a lot of sproikers talking about how they can, get you 20 investment houses in 3 years or something like that. But I think the real average is a couple. Location and lifestyle factors are obviously really important. So parks, beaches, shopping centres, transportation, public transport. Obviously, they help valuations and rents. And of course, the macroeconomics. So general affordability, availability of money, especially for us, valuations. So valuation of the land going in, valuation of the product, so that purchasers have a confidence when they pre-purchase a product, a house and land package or something from us, that at the end it's going to value up, and that the deposit that they have usually worked very, very hard to save is going to hold up, and the banks are going to give them, the required level of debt that they had banked on, and they don't have to put their hands in their pockets for more than they thought. So traditionally, of course, that has been very transparent over the past couple of years with very low rates of interest and things like that. And, that's become a little bit less so now. But nevertheless, in the kind of product that we're building, we're finding that the valuations are still stacking up. And of course, one of the great things is that employment, as I said before, is still kind of at a record all-time high. And so people are generally able to, service those kind of, amounts that we're talking about and fit into our demographics. So.
Yeah, I think that's really, really helpful. Ultimately, being able to rely on a data-driven criteria for filtering out the noise can be really, really helpful for investors. So I appreciate you walking everybody through those elements. They are obviously very logical. If you take all of that into account, all of those macro factors that those key drivers of the property market that you've just described, and apply them across the country at the moment, where do you think which parts of the Australian property market do you think will perform well, taking those things into account?
Yeah, sure. Well, look, we're pretty lucky in some respects, because we have, our main property business in Southeast Queensland, and Southeast Queensland has probably been historically the better market, apart from, premium Sydney residential occasionally. But of course, as we said, it's just gone down more than anywhere else. But it's pretty hard to argue against the Southeast Queensland property market. There's $134 billion worth of infrastructure spending going on in Southeast Queensland. There will be more money coming, obviously, from the federal government for Olympics. And it's not the Olympic Games that's really important itself, but it's the infrastructure that will be built to service the Southeast Queensland corner for the Olympics, because they are the legacy projects which will benefit the residents and of that market, not 2 weeks of Olympics in 2032. So people talk about the cost, but cost of infrastructure is really high. If you don't have an Olympics, you won't get probably the grab bag that we have been able to secure because of that, and that's generally often why governments pitch for Olympics, because they get more than their fair share of infrastructure. This is the Southeast Queensland Games. We're going to, it's called Brisbane 2032, but as we know, many of the sports are going to be taking place in the regions, on the Gold Coast and on the Sunshine Coast, and even as far north as Townsville and Cairns. So whilst we're not in Townsville and Cairns, we certainly think our projects in Southeast Queensland will be beneficiaries of that spending. So where the Olympics will generate about 100,000 new jobs. There'll be 500,000 tourists and 20 billion in tourist expenditure in the lead up to the games and the games itself. And 700 billion will be spent on infrastructure projects, around Southeast Queensland in anticipation of the games. Some of those will be funded by the state government. Some of those will be funded by the feds, and some of those will be funded by Brisbane City Council, and some of those will be, spread across each of those three government sectors. So there's a lot going on in Southeast Queensland, and as I said, we are the beneficiaries of the strongest net interstate migration of any state, and we are starting to approach, in a post-pandemic world, the record numbers that we were starting to see pre-pandemic. And one of those issues, of course, we do see in the housing market in terms of rentals. But as I said, the Federal Minister for Immigration is talking about changing those visa requirements to allow more permanents in, and that's just going to place more pressure and more growth in our markets. So we expect there's never going to be an oversupply, we think, of residential accommodation within the next kind of couple of cycles. We're always going to be a behind the eight ball. We're never going to be able to build it fast enough for people.
Yeah, there's definitely a sense when I speak to local government, Brisbane City Council, City of the Gold Coast, there is a buzz around Southeast Queensland that is very, very difficult to deflate right now. And I have a view that within whatever it is, 8 years, 9 years, by the time we get to the Olympics, you will have 3 major Australian East Coast cities that are on par with each other. And I think no longer will Brisbane be, the 3rd most interesting city in the country. I actually think that this is a really important period for Brisbane. And you can feel that buzz from everybody, from entrepreneurs to, property developers to investors in the space to people that live there, and even all the way through government. There is a real excitement about the potential of this region over the next 8 years in the lead up to the Olympics. And I think it's absolutely warranted for so many reasons. What about the regions? What about outside the metro areas? Where are you seeing strong opportunity there?
Yeah, well, obviously, Gold Coast and Sunshine Coast regions, have been historically strong. In the Sunshine Coast, you do have really major issues with land availability and also with council approvals. That puts a natural kind of bottleneck on the supply of new housing in that area. Gold Coast, there's not a lot of land left either. And there are some floodplains and other mitigating factors in relation to that. And also a few traffic issues if you're right in the Surfers Paradise area. So we obviously have a townhouse development that we're in the market for in Carrara, which will offer beautiful kind of 3 and 4 bedroom product, and really suit that kind of net interstate migration and external migration market, we think. So the price points on there are probably the most expensive product in our portfolio at around 1.5 million each, and that is a really, really beautiful project. And of course, we've always been pretty strong on Toowoomba, and I think anyone who is in the southeast region particularly understands that kind of strength of Toowoomba. It is our where the paddock really does meet the plate in terms of the southeast market. So there is a lot of wealth in Toowoomba. You and I have both recently, been up there. If you drive down Toowoomba's main streets, and there are several main streets, you're lucky to see a vacant shop there. And it's all high quality. It's expensive. People are out there spending money. We've had really good rains, of course. And then we've got some really serious major investors who, are domiciled in Toowoomba that have put a lot of their own money into the region. Of course, the Wagners are very famous for that, really. Incredible. It's a kind of Maha Sinnathamby story in terms of he kicked off a city in southeast Queensland. They kicked off a private airport and everything that's gone around that. And that really has kind of supercharged that area just on top of the natural benefits that it does have. You know, Toowoomba Range Road has taken the trucks off the streets, and they kind of go around the range now. The inland freight rail line, you know, they've got a big office up there for that. They've got a new $175 million entertainment precinct in Toowoomba, and from a housing perspective, it's undersupplied with really good population growth above the Queensland average, and that's why you know we're long on Toowoomba, looking for more things around there if we can. We've obviously got a really good project there, which on a soft market, you know, we've sold pretty well 35 things out of our first 75 without doing anything too much at the moment, and looking to deliver those first, you know, 75 lots that people can start building on by the end of this year. There was a story in the paper today, a Coles-backed shopping centre in Glenvale has just achieved a absolute record price for any regional shopping centre in Queensland. So that beat one out from Sippy Downs from 2018. And of course, Sippy Downs is the suburb just off the Sunshine Coast. So you know, to have that kind of, and that was a Victorian investor. He looked at the demographics and the fundamentals for Toowoomba, and a Coles-backed asset with some other retailers in there, and you know, paid an exceptional price for an asset in you know, shopping centre in Glenvale, same suburb as us. So we think those kind of things are really, you know, supportive of our decision and our vision, and indeed the market is showing it by purchasing our product there.
Yeah, I think that's right. I think the Toowoomba story is very, very strong. You know, some of the things I like about it include the fact that it is already the, you know, Southwest Queensland Centre for Public Administration, Education for Health Services, as well as being one of Australia's leading regions for agricultural productions, the whole Darling Downs Basin. And as all of that new infrastructure pipeline begins to roll out, it will also become a national centre for defence, for advanced manufacturing, for agricultural technology, for ag tech, which is really, really interesting to our venture capital business, as well as becoming a major Asia-Pacific transport and logistics hub. It's very difficult, I think, to find another regional area that ticks the boxes in terms of the property market fundamentals, quite like Toowoomba does. So it's going to be very interesting sort of to watch that roll out over the next couple of years.
Yeah, absolutely. I mean, those fundamentals are really incredible, because the Queensland government, you know, has forecast kind of 1,700 new residents each year, and there isn't the housing stock there to supply that. You know, in the last 12 months, Toowoomba's been the fastest selling, you know, property market in regional Australia. Median house prices have kind of gone up 24%. Rental yields are up. Vendor discounting is virtually nil. And that's, you know, that is the Toowoomba story at the moment. You know, 6 months ago, when we were thinking about the Wagners Airport, you know, we were just kind of gobsmacked when they come out with something, you know, absolutely brand new, like an aerospace industry. So, you know, the people that service just those industries at Glenvale and at the airport, as well as some of the other industrial out there, you know, are going to be living in homes that we're building out there.
Yeah, I mean, it's now the home for Boeing and Qantas, and as you said, you and I have spent some time out there. I've spent some additional time out there, you know, walking the pavements and meeting folk and trying to understand the pulse of the place. And it's absolutely not what you'd expect. You know, there are pilots and professionals and all sorts of walks of life finding their way to what is likely to be a very, very exciting new city. I mean, it's the second largest inland city after Canberra. So it's certainly got a lot going for it. And I think it's a very exciting space to watch. I mean, if I just reflect for a minute on our Glenvale project, which has closed for capital raising, but it we were able to, the sales team were able to sell 35 lots without any branding in a matter of a couple of months. And they did that at prices which were 10 to 15% above the official valuation. So it's really quite extraordinary what's going on out there.
Yeah.
And very exciting to observe. They just finally, before we kind of move on to sort of projects and different things, are there any other, zooming out for a minute, are there any other drivers that are influencing your decisions about locations and markets that might be of interest right now?
Yeah, well, certainly we obviously try and think, we're an alternative asset manager, and we do try and think outside the box a little bit in terms of asset types, locations, yields, or income streams that might be of interest to our investors. What we did is we took a good look at some of the markets, and we've put our foot on some properties in Auckland, so commercial properties on Auckland Harbour, where they make all of the yachts that were sailing in Sydney last weekend. And Auckland Waterfront's an incredible, an incredible space. It's a portfolio of assets that you would not be able to get in Australia in terms of, like premium but small on the waterfront. If you're after $50 million worth of property in pretty well any Australian capital city, they would all be, very much secondary assets. Now, the New Zealand story has taken a little bit of a buffeting, particularly this year with some natural disasters and things like that. But the properties got through them really well. So we have positioned those properties with some underwriting. We've partnered with a large Australian partner with Alcyon, who's an institutional, great property investor, who are putting some money into this asset. And what we've done is we've locked in some really low interest rates on the debt. It's an asset which is 93% leased, and we'll hopefully get it to 100% in the next year or so. And even at the 93% at the moment, it's kind of showing a 9% or 9-cent distribution, which is for for premium commercial is really, really good. You're seeing some groups kind of come out with regional shopping centres at the moment that might pay you 7%, and in a high interest rate environment where you can get bonds at 4%, that's not much of a premium for risk on top of that. So New Zealand is further into, let's call it, the trough than Australia is. Their interest rates are another percent or more higher than us, that are around the 4.5% mark. And they will turn the corner and they'll come out faster than Australia as well. They're a nimble economy, and they're probably at least nine months ahead of us. So what we'd be looking to do is to be holding on to those properties for 3 years, to be able to position them for sale for the benefit of investors, probably around year 3. And until that event, we think we've got the backing of that 93% leased to some really good New Zealand and, in fact, Australian companies. It's the head office for Ray White over there, for example, which underpins those assets. So we think they're a bit of a kind of counter-cyclical opportunity, which is got some good backing, and in terms of lowering that risk right down. And if you've got those fundamentals, one thing about direct property is, unlike listed property, they're not subject to the winds of the equity markets, dragging a share price up or down, no matter the fact that today the rent's getting paid at $100,000, and tomorrow the rent will get paid at $100,000, kind of thing. So direct property values are less susceptible during those economic cycles than listed property. So you'll be able to go to, if you invest with us, you'll be able to go to New Zealand and go to a really nice lounge that we have as part of the portfolio, and to be a small part owner of some of the best little commercial properties in Auckland and New Zealand. So
Albert's is very, very special. It is absolutely
very sexy.
class.
Yeah. Well, in fact, I've actually never seen anything like it in Australia.
No,
It's an offer, and I'm Brisbane, you're Sydney. You live and work, around the CBD there, and I have a lot of background in commercial property, and it's an offer that I've never seen. It's exceptional, we'd like to work with Alberts to take that model, further potentially into the Australian and other markets as well. So,
I think that's an excellent idea. David, thank you for your insights on all that. It feels a lot calmer and a lot clearer to me. I hope it's been helpful to our audience. I want to apply all of that if I can. And in the time that we have available, I'd like to give our attendees a quick summary of some of the current projects that we are working on, and just show you how we apply the things that David has spoken about in relation to each of those projects. Each of these projects are live. They're at different stages of development, but all of them are open for current investment with different levels of capacity left in each tranche. Some are very, very close to closing. Others have just opened. So they're at different stages. At the end of the discussion, we'll give you an opportunity to indicate your interest in any of these projects. And we will prioritise those people that express an interest here tonight, and make sure that we have one of our team members contact you in the coming days with a little bit more information. So let's jump straight into it. Tam, if we could have the next slide, please. Folks, this is Dave mentioned this earlier on. This is a project that a number of VentureCrowd managed funds have invested in. It's a boutique project on the Gold Coast, high on a ridge, 8 kilometres from Broadbeach, views to the Surfers Paradise skyline. Very, very cool architecture. It's going to be developed into 58 high-end architecturally designed townhouses inside a private gated community. The dwellings will have communal recreation facilities, including a pool and an outdoor kitchen, as well as a massive expanse of private conservation area all the way around the ridge. The fundamentals for Carrara, to pick up on some of the things that we were hearing from David, are very strong as a location. It's on the Gold Coast, so none of this will surprise you. But for Carrara specifically, Carrara benefits from 37% capital growth in the last 12 months. It has rental yields of 5.4%, which outperforms Sydney, Brisbane, and Melbourne. It's also got really strong population growth. Again, that's not going to surprise anybody, with an average of 13,000 new residents every year, who need to be accommodated. The other thing the Gold Coast and Carrara in particular benefits from is $6.3 billion worth of infrastructure spending, which is currently underway for Gold Coast specifically. The project is also forecasting a healthy development profit of circa $10 million. VentureCrowd owns all of the ordinary equity, so we wanted to position our interest with the interest of investors. So we're absolutely aligned with the best possible outcome for the profitability of this project. The current investment offer that's available, should you wish to participate or increase your allocation, targets a 12% return over a 24-month period. You can choose to receive your interest monthly, or you can capitalise your interest to the end for a higher return. Next, we've got our project at Albany Creek. This is another one that I'm very, very keen on. This project involves the development of residential property at Greensill Road in Albany Creek. It's DA approved for a 47-lot townhouse development with a duplex dwelling, which will be constructed over 2 freehold land lots, complemented, as you can see there from the main image, by this beautiful riverfront green space that sort of drops down onto the river, and a parkland which is rehabilitated council riverfront. The project is intended to be delivered over 2 stages. The builder has been appointed. The builder is Buildia, and significant progress has already been made in respect of all the civil works, as well as slabs and frames for the first few houses already in place. If you go onto the website, you'll be able to see drone footage, which will show you what the project looks like only a week ago. So we're very excited with the progress of that. It's a very strong area The exit strategy for it is to simply build and sell dwellings for profit. We're not intending to keep any of them at this stage. And the estimated completion date for the project is June 2024. Touching on the market drivers that David spoke about, Albany Creek as a location also has very strong fundamentals. The key ones are this: the median house price in Albany Creek has increased over 26% over the last year and over 41% over the last 2 years. That really is extraordinary. Rental yields of 4.16%, again outperforming Sydney, Brisbane and Melbourne. From a population growth standpoint, also strong, with an average of 10,000 new residents moving into the area every year. The median weekly household income for Albany Creek is 35% higher than the Queensland average, mainly because the demographics of the area are such that a higher proportion of tertiary educated students reside there. That's good for lots of reasons. It's good for properties that are looking for quality tenants, but it's also good for first home buyers who are looking to get into the market. This project accommodates both of those demographics. The current investment offer that's open is targeting a 12% return over an 18-month period with distributions paid monthly. The first tranche of this project was $8.5 million, which we raised to acquire the property and commence the civil work. That was closed in a week. So there's a lot of demand for Albany Creek, and we're very excited about the prospects for this particular project. The next one is a property at Riverview. Riverview, this project is DA approved for 115 townhouses, 3 retail tenancies and 4 apartments. And it's located in a suburb that's part of Brisbane's thriving Western Corridor. This particular area benefits from $15.3 billion worth of major transport and infrastructure projects that are either currently underway or planned for the region. The median house price in Riverview has increased 44% over the last year. This is one of the highest performing suburbs in the country, and it's an excellent sign for both housing demand and also for potential project gross revenue increases over time. So if this continues, we expect to be able to lift the gross realization for the total project as it's being rolled out. Rental yields are also very strong at 5.5%, again, materially higher than Sydney, Brisbane and Melbourne. And from a population growth perspective, an average of 7,000 new residents are moving into Riverview each year. So big ticks on all those kind of major factors. The current investment offer is a little bit unusual and has been driven by investor demand. This one targets 10% paid monthly over a 36-month period. So you're in for the project for 3 years, but it also includes a 50% profit share on completion. So on the current forecast, that would result in an IRR, an internal rate of return of just over 21% based on the current forecasts. This one is particularly attractive if you're in a position to deploy capital for a 3-year period. Cannon Hill is the next one. This is a DA-approved project for 45 apartments over 4 stories in the high-growth suburb of Cannon Hill in Queensland, very centrally located near public transport, schools, childcare, and shopping centres. This is if you know Brisbane well, and you know Cannon Hill, you'll know this is a highly sought-after location, in particular for inner-city workers, because it's only 6 kilometres from the Brisbane CBD. And according to our research, heavily undersupplied. So we are bullish on the prospects for both sales and rentals of this property in due course. From an investment perspective, we've got 2 products that are running side by side, again, driven by investor demand. The first one is targeting 16% per annum over an 18-month period, with interest paid at the end of the 18-month term, so it'll capitalize. And the second one is a pure equity product. We haven't offered a pure equity product in a while because normally VentureCrowd holds the equity right till the end. We'll hold some of the equity in this project, but we're also offering about $1 million tranche of pure equity product in the project, which will take both equity return and equity risk. On the current forecast, though, the return on investment for the equity product is circa 40% over an 18-month period. Obviously, equity returns are subject to usual project risks, and that target may change. We all know that, I'm sure. And then finally, I'm just going to touch on Auckland. David's already done this, but we also have a new opportunity on the Auckland waterfront. The fund will hold 3 AAA grade rated commercial office buildings right on the marina there, 93% leased with very strong tenants, including Ray White and F45, with strong existing rental income and a solid forecast for growth. The product is targeting, as David said, a 9% distribution for investors in year 1, which we expect to increase to an internal rate of return of about 14% by the end of year 3, provided we can execute on our plan to improve the property, fill the balance of the space, and increase those rents. The lead investor in this fund is one of Australia's leading institutional alternative assets investors, the Aussie Group, which is led by some of the former Babcock and Brown team. If this is of interest to you, let us know, and we'll have one of our members reach out to you to provide further information. Now, before we go to questions, I'm just going to ask Tam to run the poll, because people are busy, and tomorrow morning there'll be 10 million other things in your inbox that you will need to get to. So to make it easier for you, do go through the questions here if you're interested in any of the projects, and we'll make sure we get one of our team members to put it on their to-do list to give you a call tomorrow or the next day, so we can make sure that you're able to secure your allocation in whatever project you're interested in. Okay. So we have now a little bit more time for questions. So we'll give you some time to jot your questions down into the Q&A function at the bottom of your screen.
And just a reminder to anybody that is interested in investing in any of the projects mentioned tonight, or if you've got an interest in some of the stuff we've got going on, please do visit the VentureCrowd website. You can book a call with one of our experienced capital managers, or you can send an inquiry via email, and we're happy to assist you with any queries that you may have, should they arise after the session and you think of something post this webinar and update.
All right. Well, if there are no questions, there that always happens as I'm
running. As you say it, it's always Murphy's Law. As you go, it happens. So the question that's come through is, how much are Alcyon investing in New Zealand? So I'm going to put it to both of you, and you guys can do rock, paper, scissors.
That's all right. I'll do it. Alcyon will invest a minimum of 20% of the equity requirement in it, and they will underwrite. If we need a little bit more, they'll underwrite a bit more as well. So it's a really strong kind of indication from Alcyon of their support for that market product.
And certainly from our perspective, what this is indicating to our investor base is a preparedness to move beyond residential development projects, and to ensure that over time we're wrapping our arms around property opportunities, whatever part of the the market that they're in. I mean, it may be in due course we begin to look at industrial, which is hot at the moment, and other things like build to rent, which we are investigating as well.
I should add, Steve, as part of this, of course, we have this is part of a new fund that we have set up that we can add assets to, with investments that are actually backed by income. Of course, most of the investments that we've done before are property development. So your money's in there and you're waiting for a return, potentially in a couple of years, if you're in there for equity, backed, of course, with a fixed income product potentially, but it's kind of coming out of the fund. This is something that is effectively being paid for by the tenants that are currently in the building, with ironclad leases, that go out over the next few years and certainly beyond the period of the asset ownership that we're looking at.
Yeah, and at 9%, I think it's highly attractive, very comparable, and is a very decent return for the level of risk such as it is in an existing project that's backed by 93% leased occupancy to some of the largest organisations around.
Do I dare say it? There are no more questions. I'm going to allow for just a quick breather, just to see if anybody is going to type anything. So, gents, please just hold on, as we just want to give everybody the opportunity to ask questions during this update. Well, we've both got you here.
Absolutely. Very happy to take any additional questions.
Okay. Doesn't look like there's anyone typing. So if you have any questions, you can reach out to the team on the email address of investor@venturecrowd.com.au. Alternatively, the contact number is 1300 039 655. If you do have any questions post this webinar, please do reach out to us. We are more than happy to assist you on that. Just a reminder that this webinar and components of it will be circulated in the next couple of business days. If you don't receive it in your inbox, please do reach out to us as well, so we can make sure that you do receive a copy. And thank you very much for taking the time out of your Wednesday evening and for joining us for this fireside chat and update in the property market. Gentlemen, thank you so very much for your expertise, David and Steve, for co-hosting and asking the questions. It's been very informative and very exciting at the same time. So I was really honored to be a part of it tonight. So thank you very much, gentlemen, and I hope you have a lovely evening.